we're either going to get a deal or it's going to be unfortunate for them. I would think that would be enough time, 10, 15 days, pretty much maximum.
President Trump says Iran has only days to strike a deal on its nuclear program as the U.S. military deploys its biggest force build-up in the Middle East since the 2003 Iraq invasion. Live from Sydney, I'm Paul Allen, and this is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. Well, sentiment is weak on Asian stocks as U.S. tensions with Iran deepen and oil hits its highest level since August. Investors also bracing for U.S. data on prices after the last Fed minute showed officials were surprisingly wary of cutting rates due to stubborn inflation. PwC Chief Economist Alexis Crow and Manulife Senior Portfolio Manager Mark Franklin will be joining us to break down the markets and economic risks. Zoom's COO joins us to discuss their AI strategy and the company's early bet on Anthropic, a stake that some say could be worth billions. And with trade deals, tax cuts and AI jitters reshaping Indian markets, we look to where to put $1 million rupees to work. Well, the focus is on growing tensions in Iran as President Trump ramps up pressure for a nuclear deal. The U.S. military is gathering forces in the Middle East, including 2 aircraft carriers, fighter jets and refueling tankers, as Trump warns Tehran has just days now to work out an agreement. President Trump addressed the talks with Iran while speaking at the first gathering of his Board of Peace.
Iran is a hot spot right now. Good talks are being had. It's proven to be, over the years, not easy to make a meaningful deal with Iran. We have to make a meaningful deal, otherwise bad things happen. We do have some work to do with Iran. They can't have a nuclear weapon. It's very simple. You can't have peace in the Middle East if they have a nuclear weapon.
All right, for the latest now, let's get to Washington Deputy Bureau Chief Laura Davison. So, Laura, the president there saying that Iran can't have a nuclear weapon. What exactly does the U.S. want out of these negotiations, and is it achievable?
The U.S. wants to severely hamper Iran's nuclear capabilities, in fact, take it all away. But they also want to have sort of more influence in the country. And there's sort of a bunch of different pieces that the U.S. wants to control here. The question is what this deal ends up looking like is still a big question. And there's a lot of speculation that it will be very similar to an Iran nuclear deal struck essentially a decade ago under former President Barack Obama. This is a deal that Trump has really criticized throughout the years and actually pulled the U.S. out of during his first term. But just given the complexities here and given the fact that Trump is not super involved in sort of the nuance of the region as well as these details here, he wants to be able to come out and announce that there's been a deal reached, that there's peace in the Middle East, but that's not necessarily what's likely or possible to come to fruition, particularly within a 10 to 15 day timeline that Trump laid out here.
Yeah, can you give us a sense now of just how much U.S. firepower has been amassed in the region, and also what's the risk of amassing that much firepower and then not using it?
Yeah, so this is a really, really incredible buildup. This is, on many multitudes the size of what we saw build up in the Caribbean off the coast of Venezuela just a couple months ago. This is, a capacity for the U.S. to wage what could be, a pretty prolonged, set of attacks on Iran if it wanted to. Trump, has not, indicated, though, he's really, clearly teasing the leverage he has here of, look, I have, all these military assets there and, and it's possible, but he never will commit that, we may use them here. This is, causes a lot of tension in the region because it's not clear exactly what Trump's end game is. Does he want to? There's been discussion of maybe perhaps some limited strike, targeting a nuclear site, or not unlike what we saw last summer, or is he thinking something bigger here that would more amount to regime change? That those are 2 very different scenarios that could really take this in vastly different directions.
Well, Israel has warned that Iran can't be trusted to keep any promises on any nuclear deal. What else is Israel saying, and what are some of the other regional partners of the U.S. in the region talking about this?
Yeah, Israel, has been quite critical of the U.S. sort of trying to cut a deal essentially with Iran, and it wants, more of a hostile military projection here. Israel was very influential in the strike that the U.S. did launch last year on Iran. We're seeing Netanyahu truly trying to keep his U.S. allies closely. Marco Rubio is scheduled to meet with Netanyahu here in just a couple days in Israel. So this has kind of been a tricky thing for Trump to maneuver. If he both wants to get a deal, he's been, very publicly out there saying, he has his top envoy, Steve Witkoff, having these talks with the Iranians, but then also, has Rubio speaking with Netanyahu, and trying to keep both of these parties happy is essentially an impossible task.
All right, Washington Deputy Bureau Chief Laura Davison. Let's check on how markets are performing in this environment of heightened geopolitical risk. It is mostly a risk-off day across most of the markets in the Asia-Pacific. Those that are open, of course, China's still closed for the Lunar New Year holiday. The Hang Seng back trading for the first day since the break, currently off a bit more than 0.5%. Once again, it's the Kospi leading the way, though, in the region, better by about 1.5%. Nikkei futures a bit softer there, also by a bit more than 1%. Gold just a sliver below that $5,000 an ounce level as investors seek havens. And, of course, the oil price ticking up, as you might expect, 71.87 for Brent crude, although while it is spiking on that U.S. military buildup near Iran, the IEA says the world's also facing a substantial oil surplus due to supplies from Americas. So a couple of competing pressures there. Well, our next guest focuses on geopolitics and long-term investing, and joining us now from Los Angeles is Alexis Crow, partner and chief economist at PwC US. Alexis, thanks as always for joining us, and I do want to start with the oil markets. I mean, so many scenarios here, and if we take a look at this chart on the Bloomberg, we see there is a lot of activity in the space at the moment. So what are the potential scenarios that you're considering?
Well, thanks so much, Paul, for having me. Delighted to join you. I think when we start to scope out this latest rise in oil prices, it's important to note that the estimates surrounding what Iran can bring to the market per day are generally pretty much overestimated. What we have to focus on is what would any prolonged and sustained congestion in the Straits of Hormuz have on global oil, and not only oil, but also natural gas markets. So roughly 1/5 of total final oil demand comes from the Straits of Hormuz, passes through those straits every day, as well as roughly 1/5 of total LNG consumption on a daily basis. And so, again, with the stacking up of U.S. troops, some of the mentions that we've had coming out of the Pentagon, I think it's very clear that you could prepare for some sort of a sustained attack. And that would, of course, be able to prop up the price of oil. So there's a rule of thumb, Paul, that for every 100,000 barrels of oil you take off the market per day, the price can move by a $1.10 differential. So you could see how quickly, if you took off 20 million barrels, how quickly the price could go up way and well past $100 a barrel. So that's the situation that we're facing today.
Is the $100 a barrel scenario, how realistic is that? Because this market has been in oversupply for so long. What is the potential impact on growth and inflation here, and how long would it take to get to that level?
So I think we have to go market to market. I mean, if we go back to the last spike in energy prices related to Russia's invasion of Ukraine, obviously that, given Russia's exposure or Europe's exposure to the Russian energy market, that hurt Europe far more deeply. In the case of the United States, for example, where there's a hyper focus right now on inflation and the crisis of affordability, you have there has been a flatlining and a declining share of Middle Eastern oil as a total final daily consumption in the U.S. So said another way, the U.S. is quite insulated, as you know, just given its prowess in producing out of the Permian Basin. So 70% of U.S. imports come from Canada and Mexico alone, a very, very slender portion coming from Saudi Arabia and Iraq. On the other hand, because Europe has been exposed to, having to deal with the flatlining of supply from Russia, they've now turned to the GCC energy exporters to be able to make up for lost supply, as well as the U.S. And so the Europeans are actually somewhat exposed. And of course, we know that Asian markets are exposed. You've seen the Saudis continuing to undercut other exporters to China on pricing and just continuing to gain market share there. So if there was any disruption, of course, that could hurt importing Asian economies. That being said, China has actually produced a record amount of natural gas just in the last year that we have, surpassing the gas output of your country and Australia as well as Qatar. So China is actually working on a little bit more energy independence when it comes to the gas side.
Yeah, there are a lot of complexities around this story to unpack. But as you say, the US probably largely insulated from any inflationary impacts should this conflict take place. And in terms of inflation, we're also getting the PCE data out of the US tomorrow. What are you anticipating to hear there?
Well, we're in this little debate, which is a historic one in economist land, which is the difference between inflation and price levels. And what we're seeing in the United States is that price levels are rising, and we have seen companies start to pass on the tariff-related increases in cost and passing this on to the consumer. So in other words, companies are taking price. Whether or not that's a one-off increase, of course, is a matter that is open to rich debate. But why we've seen inflation soft in the U.S. for two reasons. One is because of the weighting towards shelter, so that is owners' equivalent of housing as well as rent. You've seen 29 consecutive months of rent declines in the U.S. We've seen a very soft housing market, and that represents 44% now of CPI. When you also then look at transportation and energy costs related to just moving transport around, you also have a softer reading because oil has been in somewhat of a bear market, and as you highlight, the oversupply. So that has weighed on this in sort of inflation outlook. One thing that we're looking forward to is, of course, the increase in healthcare costs, which is, as you know, in America is of acute concern for lower income households. We forecast that will increase by 8 to 10% this year as well. What I think many are focused on, again, and what central bankers are focused on, is whether or not this tariff increases that we're starting to see passed on the consumer will be one-off, which monetary policy can therefore look through, or whether or not these will lead to more sustained price increases as well, whether or not this will lead to any kind of increases in wages as workers will have more bargaining power. So that's certainly some of the things that we'll be looking for.
Yeah, and we do have to look at this through the lens, of course, of what it means for Fed policy. I thought it was kind of interesting that we heard from Stephen Meyer, and he's been dialing back calls about how deep rate cuts should be, which is curious because he's a Trump appointee. Do you feel like there's a risk that maybe the market's not going to get the two cuts that it's pricing in 2026?
That's certainly a risk, just given where we are. Again, the latest jobs data that we had, quite strong. Now, you've had Mary Daly from the San Francisco Fed highlight the extent to which we have to be focused, that this is not just coming from one sector. So obviously, as you saw from the data, that was predominantly focused in healthcare and home services jobs. So we can't just be operating on a growth in healthcare jobs. And so that's something that's going to come into focus as well. But if the labor market is healthier in the United States, if companies aren't massively cutting related to Gen AI, then the Fed can focus on its other part of the mandate, which is, of course, related to inflation. And again, we come back to, if there is any kind of sustained conflict in the Straits of Hormuz, you will see the price of oil come up. And even though the United States is somewhat more insulated, we also know the extent to which the rest of the commodities basket generally follows the price of liquid fuels. So in this case, oil and natural gas.
Now, I know you see more US dollar weakness ahead. How much weakness do you see ahead, and which currencies are most likely to gain versus the greenback?
Actually, Paul, it's going to be interesting to see if we do have a conflict in Iran, what happens to the greenback, right? Will investors go more toward the Swiss franc or the yen as a safe haven rather than the dollar? So that's something that we're definitely going to be watching. DXY down roughly 10% last year. Our forecast is it goes down another 10% for this year. And then I would say it probably doesn't have much further to go because investors don't have many other options, right? So we have the yen, we have the euro, Swiss franc being small but present. And so I think after that 10%, there's not much more room to grow. I would say also we have to think about how this is going to contribute to the affordability crisis in the United States, where dollars are just getting you less bargaining power. Over 60% of fruits and vegetables in America come from imported sources. So again, I think lower income households will be feeling some of the brunt of this as well.
All right, Alexis Crow of PwC US is going to be sticking around. Still ahead, semiconductor shortages squeezing big tech's AI ambitions. But OpenAI's Chris Lehane tells us the company still sees its chip path clearly. We'll have more from that conversation next. This is Bloomberg. Welcome back. You're watching Insights. OpenAI says it has visibility into its future chip needs, even as the industry faces a supply shortage. Chief Global Affairs Officer Chris Lehane also told us democratic nations need to develop shared safety standards for AI.
Democratic AI is going to prevail, or if the world's going to build out on democratic AI, I do think the world does need to work together collectively to make sure you're addressing and identifying the elements that are going to be needed. And look at, we are, and I know you guys talk about this and cover this, right, in a unique and perhaps challenging geopolitical moment where I actually have some optimism in terms of where the world's going, particularly democratic world, is that we all are going to have to work on this together. Democratic societies do need to start to develop shared safety standards on this technology. You're seeing emerging AI safety institutes, U.S., U.K., Japan. Australia has an early version. India's thinking about an early version. And he talked about, can we think about this as some type of analog to the IAEA, the International Atomic Energy entity. But I think those are the types of I think muscles that we're going to really need to develop to ensure that democratic AI does get built. But inclusive within all of that too is how do we all work together, particularly on the supply chain piece.
But as it stands now, do you see this chip shortage deepening further, and will that slow down the AI build out? From your perspective, how does it look?
From our perspective, I think we feel confident that we have visibility onto what we are going to need. Now, we also make sure we sleep with one eye open, right? Because you want to continue the old line, trust but verify on all of this. We ourselves are, working with a variety of really strategic partners who are, really supportive of us in terms of access to chips. We ourselves think about how do we impart our knowledge on chip design.
That's OpenAI Chief Global Affairs Officer Chris Lehane speaking with Bloomberg's Haslinda Amin in New Delhi. Well, Alexis Crow, partner and chief economist of PwC US, is still with us. And Alexis, I know you've noted in your research that PwC says the AI boom is an anchor for market confidence. But do you feel like we're seeing enough productivity gains here, or are you starting to detect a whiff of .com style bubble?
Well, Paul, thanks so much. So interesting, the St. Louis Fed has recently run some research on comparing and contrasting this current boom to the .com bubble. And one of the things that they have pointed out is, in contrast with the .com bubble, is that you have this overwhelming investment in data centers as a new component of this. And of course, that's not only a tech play, that's a real estate, that's a highly leveraged play as well, and it's an infrastructure play. And so all of this is dependent upon huge resources in terms of energy as well as human capital to build this. So that's a new component of it. And of course, it's one that has investors directing billions of capital to the United States, but also looking to Japan as well on the chip supply and data center side as well. So I would actually say that, Paul, I think you could have a moment where some companies realize that they're not getting the exact type of ROI that they expected to receive. And we've seen that is heavily concentrated within the tech industry itself. But I think there will be an impetus on executives to continue to invest. I would also say that there can generally be a little bit of a blurring of the lines of what is a digital investment, what is a technological investment, and what is actually strictly AI. And there's some sort of convenient blurring that's happening at the moment.
Do you get troubled at all when you see some of the circular deal making that gets made in this space?
I think when you start to look at CapEx times earnings, this is where you start to see things looking slightly frothy. And that is, of course, what has some investors concerned. Governor of the Bank of England, Andrew Bailey, has highlighted that you could see a scenario in which there could be a tech bubble that bursts, but that companies will continue to try and invest in AI to improve productivity. So I think those two scenarios could very well play out.
Yeah, you mentioned a moment ago that this is all about data centers as well, the infrastructure required to build them, also huge and increasing energy demands also. Do you see some of the spending and particularly the pushing up of power prices as creating a bit of a problem for the Fed going forward?
So first of all, there's one forecast from the government is that residential electricity prices will go up on average by 8% this year. So for lower income households that are stressed, that's obviously an area of acute concern, perhaps underscoring one of the reasons why the administration is focused on getting some of the hyperscalers to go out and bid for energy contracts. So that is, in the United States, that's something that we highlight that's very, very acutely focused in certain regions, such as one interconnection in the East Coast as well as Texas. And a problem, Paul, is when you start to remove wind and solar energy from the energy mix. If Texas was a wind power as a country, if Texas was a country, not a state, it would be the 5th largest wind power in the world behind Spain and France. So if you start to, again, remove some of any kind of energy sources, that's compounding the issue. One thing that I would be focused on, and this is something that we've actually highlighted for the last few years, is everyone is focused on Gen AI at the moment. But will these data centers be kitted out and ready for the next big thing? And if that's quantum, that's something that we have to focus on. And that is something that I would counsel and guide investors to think about is, if we're channeling everything to the next big tech thing, I think we have to think about what is after AI.
Yeah, also before AI makes all of us obsolete, a significant amount of human capital is going to be required to make all of this a reality. Are the immigration settings in the right place to make this build-out happen?
So as you know, data centers obviously require a huge amount of skilled workers to begin with, and then after it's developed, not as many. And we have an acute shortage of construction workers in the United States right now. You've had some publications referring to this as a gold rush for certain construction workers to go to data center sites. We entered into COVID with a shortage in construction workers. I recall working with one client who had to poach a worker from a hotel development site in Las Vegas to take them to Seattle. Mm-hmm. And so, of course, some of the restrictive immigration policy has compounded that issue. Yep. We've also started to see wages move. Wages for all industry in the United States here, but wages for construction coming up significantly. Yep.
All right, Alexis, we'll get back to you in a moment. Alexis Crow of PwC is sticking around, and we have more to come. This is Bloomberg. Okay, let's take a quick look at where markets stand. Foreign investors, well, hang on, let's take a look at this first. We've got Japan on the lunch break at the moment. There's no way you're not seeing that moving at the moment, off by 1.3%. Not a great day for Japanese stocks. Not a great day across most of the board. In fact, the Hang Seng Tech Index off 2.5%. The Hang Seng Index off about 0.75%. First day back trading since the Lunar New Year holiday. Not all doom and gloom on the tech front, though. Once again, the Kospi having a really fantastic day, better by 1.5% to round out the week. Elsewhere, we're seeing a pretty interesting haven trade going on. Japanese 10-year bonds catching a bid, gold also hovering just below that $5,000 an ounce level, and crude prices rising as, of course, the U.S. parks that impressive armada off the coast of Iran. Now, let's talk a bit more about Japan, because foreign investors bought the most Japanese stocks and futures in more than a decade in the days that followed Prime Minister Sanae Takaichi's election win. Japan exchange data shows foreigners bought a net $11.5 billion worth in the week ended February 13, and that's the most since November 2014. Takaichi's victory has fueled expectations of political stability and more government spending. Well, Apollo Global Management is looking to provide private capital to fill a crucial niche in Japan's investment landscape. CEO Marc Rowan spoke with Bloomberg's David Weston for Wall Street Week.
Japan is I would say like many economies. If you think about the structure of the Japanese market, it is primarily two financial products: bank debt and equity.
Apollo CEO Marc Rowan sees his company as providing a much-needed third way to finance the capital investment Japan needs.
The equity market in the context of the world is actually quite small, although it is the second largest equity market in the world, but it is roughly the size of NVIDIA. Just to put things in perspective, there's not the well-developed, kind of corporate bond market that exists throughout the U.S. And so I think what we're watching, not just in Japan, but around the world, is corporate CFOs, corporate treasurers now understand that there are three types of finance. Things that are really highly rated and short, you want to be with your banks. There's no better provider. Equity, very, very expensive. Public markets, for plain vanilla, very, very good execution. Everything else comes to the private market. The largest part of the private market today is investment grade. It is these large companies who have these transformational opportunities, who want to match long-dated investments, and most of what we're doing is long-dated, with long-dated capital. And that is not what the banking system does well. That is not what the public markets do well. And so you're seeing this extraordinary growth. In the US, we've seen it in lots of ways. Meta's financing last year at some $30 billion. In Europe, we've seen the Europeans, who also have structural issues vis-a-vis capital availability, really embrace private finance. In Japan, we're seeing the beginnings of that.
That's Apollo Global Management CEO Marc Rowan speaking to Bloomberg's David Weston there. And you can get more in a special edition of Wall Street Week from Japan. That's airing 7 a.m. Saturday in Hong Kong, and that is 8 a.m. in Tokyo. Well, Alexis Crow, partner and chief economist of PwC US, is still with us to share her views on Japan this time. And Alexis, as we mentioned there, since Sanai Takaichi was re-elected, we've seen those huge foreign inflows into Japan, the highest since 2014. Do you expect this momentum to continue?
Well, I think we have to look at, it's not even just equities, it's also long-dated bonds. You had the greatest overseas inflows into long-dated bonds last year. And I think many market participants, if you think about it, let's put it in the context of just the yen as being a safe haven. And so many market participants have looked at the United States as being overpriced, where valuations have been quite high, overplayed, policy uncertainty. And so many have looked to Japan with fresh eyes. There've also been, the weak yen obviously supporting inflows into the equity market, promises of governance reform, and we've seen real fruits of that, as well as what you highlight, which was Takaichi-san's, the expectation of having a very fiscally dovish stance. So she is taking a page straight out of the late Prime Minister Shinzo Abe's book here, and I think that promise has led to all of these inflows. And Paul, we're also seeing that on the sticky capital side when it comes to FDI inflows. One of the topics we mentioned on AI and data centers and chip fab is that many investors are actually coming in to be able to deploy capital to that space in Japan.
You mentioned the weak yen there. I mean, it's softened again today. We're back at 155. It can't seem to really break out of this range. How much of this rally do you attribute to the weakness of the yen? You mentioned some other factors there as well, but is that the biggest factor? And what's the risk of a repricing of the currency as the BOJ looks to normalize rates?
Well, I think we're on a different path now with Takaichi-san than we were in the previous administration. And so you've seen actually stark warnings from the IMF just this last week toward the government to be able to potentially not suspend this consumption tax, which is a motion on the table, and to be able to continue the path of policy normalization and raising rates. We have seen the BOJ, of course, focus on reducing its balance sheet. We noted that at that current pace that it will take more than a century to unwind its balance sheet. So that's the kind of volumes that we're talking about. Look, I mean, I think looking at the weekend, that's one component. We know the extent to which that has supported what we refer to as Japan Outbound Inc. and the topics-related companies that are exposed to sales abroad, such as automotive, have, of course, been supported by this. I think we have to look at also what's going on around the rest of the world. Dollar-yen, we know that the dollar is set to soften this year. Again, we mentioned if there are sort of geopolitical shockwaves coming from the Straits of Hormuz, will people come into the yen and therefore will it strengthen? So I think another facet of this is a similar facet to the United States, which is just the fiscal situation. And so one preview of the budget last year from the finance ministry highlighted that the finance ministry would ask for the single greatest amount of interest payment that has ever been requested by a government. In latest iterations that we've seen as we wait for the budget in Japan, you've actually seen the finance ministry coming out to the next fiscal years will be spending 30% of total government expenditure on servicing the debt. And so these are huge numbers that have also, of course, going to weigh on the currency.
Yeah, when you look at something like that, I mean, is it not just the concern about the currency, but how sustainable is that going forward? I mean, the debt in Japan just seems to keep piling up without consequence. Is there going to be a denouement one day?
Debt issuance will also have to increase by 30%, according to the finance ministry, over the next 3 years. So here I would come back to a wonderful colleague of mine in the U.S. says that, one of the reasons why the United States continues to print debt is that the world demands it. And we see the extent to which JGBs have also just been a safe haven. It is the largest amount of government debt now in the world. And so I think the extent to which investors, and particularly even looking at Japanese investors and domestic investors, will continue to request this debt, that the government will keep printing it.
I want to talk a little bit about growth in Japan as well, because we saw some huge exports out of Japan, particularly to China, in the last set of numbers that we got. Yet growth's not really moving that much. Can you unpack that for us?
One of the former Cabinet Office officials has just very clearly stated that Japan is in a deflationary mindset, and that is the place that the country has been in for quite some time. You go back to some of the efforts from the late Shinzo Abe cabinet to be able to improve productivity levels for over 65 workers, which really worked, to be able to include more women in the labor force, which really worked, but this hasn't had a meaningful knock-on impact on growth. Something that one of the top executives from Japan has highlighted is the extent to which the country has really not leapt forward into the fourth industrial revolution and into that part of the digital journey. So that Japan really excelled in terms of productivity and output related to the first few waves of the ICT revolution, but it really never jumped from the third to the fourth. You could actually liken the economic performance here somewhat to Germany, where Germany also hasn't really made that leap. And so there has been a focus by executives. How would you do that? What would you do in terms of labor reform to really jumpstart that? Another side of it, though, is something that we've tracked since 2022, is consumption has actually been fairly strong in Japan. Now, we know part of that is going to just be related to imports and food imports, but consumption by domestic consumers, particularly in the Tokyo metropolitan area, has been somewhat strong. So I would be curious to see how the Gini coefficient actually behaves over time in Japan.
I'm wondering if also you could unpack the inflation data that we got out of Japan as well. CPI slowing to the coolest pace in 2 years. Is this going to create a problem for the BOJ? And do you feel maybe they missed the bus when it came to tightening?
I think that the BOJ is going to be very focused on what the new government wants, and I think that's going to be the new tension going forward. And it seems to me that we have every evidence that Takaichi-san will be following this fiscally dovish stance. So again, you've had these stark warnings from the IMF this week that the BOJ must continue on the path to raise rates, and I think that's where the focus will be, and there's likely to be tension playing out between the two.
All right, Alexis Crow of PwC US, thank you so much for your time today. We have plenty more to come. This is Bloomberg. Welcome back. You're watching Insight. Paraguay's President Santiago Peña says he applauds President Trump's decision to launch a military operation to capture Venezuela's Nicolas Maduro. Peña also told us Latin America could benefit from Trump's renewed focus on the region under his interpretation of the Monroe Doctrine.
I fully support. I think this is something that we have been aiming for a very long time. We had a long history of good relation with the U.S., regardless of who was the president or what party they were representing. But the reality is that always we have a closer relation with a Republican government rather than Democrats. So this time Trump came with a different approach, much faster on deciding on things and paying a lot of attention to the Western Hemisphere. So when the new national security strategy came out and they start talking about revitalizing the Monroe Doctrine, I think it's a good idea. I mean, it's not that we're going to be the same countries that we were 200 years ago. We are completely different, and the type of partnership that we have built is different now, is stronger, and we see each other as an ally. So it's not that the U.S. will colonize the countries in the Western Hemisphere. So I really appreciate that they're paying more attention. I think that there are so many things that we could do. And in the case of Paraguay, of course, we are the only country in South America that still have relation with Taiwan. Mm-hmm. So this is not a minor issue when they think about the influence of China in the Western Hemisphere.
I do want to ask you about Taiwan, but if we could stick with Venezuela for just a moment longer. Do you see Latin America as now being safer, more stable after the capture and arrest of Nicolas Maduro? And how do we guarantee that that is something that can last? Is Delcy Rodriguez the person who can complete that job?
We need to work around on this, and it's going to take time. And Paraguay knows very well. You know that Paraguay had the longest dictatorship in South America, 35 years of a military regime that ended in 1989. So the transition after the military regime, it took around 4 years. A transition government, a new constitution, and elections, and after 4 years we can resume on democratic terms. So this is not something that you're going to solve in 8 weeks, because it have happened only 8 weeks since the removal of Nicolas Maduro. Of course, we don't like this as the first choice, but it's the second best. We push for democratic elections through the elections that happened in 2024. They did not respect the results, so there was no other option. So dictators, they don't go with pamphlets and manifestations on the street. They usually go with bullets.
Until there are democratic elections, are there opportunities for Paraguay and Venezuela in terms of your relationship and economic relationship in the interim, or do you need to wait to see that happen?
I think for us, it's not a matter of a lot of pressure. We don't have a lot of pressure. Paraguay is an economy that is growing. It's actually the fastest growing economy in South America for 3 years already. So we're doing really good. We are exporting and doing trade with many countries. We have a lot to offer. But we don't depend on accessing the Venezuelan market. I think that now the challenge is how to stabilize on the ground, particularly freeing all the political people that is imprisoned, allowing Venezuelans to return to Venezuela. And with the situation more stable, I think the most important thing is letting the people of Venezuela to choose who's going to be the president. And it's going to take some time.
Do you have an idea of how long?
If I give you my own experience in Paraguay, it took around 3 to 4 years. Okay. So I hope that it could be sooner, but it's going to be around that time.
That's Paraguay's President Santiago Peña speaking exclusively with us in Washington. Here are some of the other stories that we're following. President Trump says his Board of Peace has received roughly $17 billion in pledges towards humanitarian and reconstruction efforts in Gaza. He also says more than half a dozen countries have promised personnel for a stabilization force in the war-torn territory. Now, the updates come as major questions remain over wresting control of the territory from Hamas, which has refused to give up its weapons. The U.S. annual trade deficit with China shrank in 2025 to the smallest in more than 2 decades. And as President Trump's sweeping tariffs reordered global trade, the U.S. deficits with Mexico and Vietnam widened to record levels. According to Bloomberg Economics, the executive tariff rate on U.S. imported goods now stands at 13.6%. Meanwhile, Taiwan's surplus with the US nearly doubled last year on a surge in semiconductor and electronics exports. US data showed Taiwan overtaking mainland China as a source of US imports as the global chip-making hub grows in importance on surging AI demand. Minneapolis Fed President Neil Kashkari has accused National Economic Council Director Kevin Hassett of trying to undermine Fed independence. Now, this is after Hassett criticized a New York Fed Economist study which found U.S. companies bear most of the burden from President Trump's tariff hikes. Kashkari defended the study, saying research conducted by Fed district banks reflects efforts to learn more about the economy.
I thought that Director Hassett's comments, though, he went on and he said that he disagreed with the results and the researchers should be punished or they should be disciplined for their conclusions. I think this is just another step to try to compromise the Fed's independence. Over the last year, we've seen multiple attempts to try to compromise the Fed's independence, including in December when the Department of Justice served a subpoena to the Board of Governors over some building expenses. It's really about monetary policy.
The CEOs of OpenAI and Anthropic appeared to snub each other during a photo opportunity at the AI Impact Summit in New Delhi. Sam Altman and Dario Amodi refused to hold hands, despite standing side by side. That was a moment that spread very quickly on social media. Amodi previously worked at OpenAI but left to co-found his company as he felt that OpenAI was becoming too commercially focused. All right, let's check in on the Indian market. It's been trading now for about 5.5 minutes. We are keeping an eye on oil stocks. I'll get to that in a moment. But the broader Sensex looking flat at the moment, as is the Nifty index, the Nifty Bank Index, the best performing at the moment, better by 1/3%. Now, of course, we have a very large US naval armada and also a lot of planes and other military hardware parked in the region around Iran at the moment. That has seen the oil price spiking, and a couple of beneficiaries of that in India, ONGC, Oil India as well, seeing their stocks rise off the back of that also. Now, we have talked extensively about the rout that we've seen in Indian IT stocks as well. Infosys, Tata Consultancy Services, HCL Tech, Wipro among them, having another down day today. Now, you may well ask just how much have we seen sell off in Indian IT stocks? Well, Bloomberg's crunched the numbers for you. 110 billion rupees worth of shares were sold in the first half of February. To put another way, foreign investors at the end of last year owned $85.2 billion worth of Indian IT stocks. By mid-February, that had shrunk to $49.5 billion, and that sell-off continuing today. Switching gears now, Bloomberg has learned that Manchester United co-owner Avram Glazer is making a bid for Indian Premier League cricket team Royal Challengers Bengaluru. Sources say Glazer's submitted a bid for about $1.8 billion. Let's get to our deals reporter Manuel Baigorri now. So, Manuel, tell us more about this deal. What do we know?
It's a fascinating saga that we've been tracking down, and we'll have a few more twists and turns as the process comes along. There is a sale process for the challengers, as with any other pretty much Indian Premier League as well. Cricket has attracted a lot of interest, and the latest we've reported on the challengers and the interest from the co-owner, of the Manchester United. That remains to be seen how it plays out, because we've seen interest also from other private equity firms and also other tycoons from India. I mean, I think cricket has become a very sought-after asset, and we are seeing increasing appetite from global investors in these franchises.
Do we know if anybody else is in the running to purchase this team?
Yes, indeed. We understand there are some global buyout firms, the likes of Carlyle and others, as well as Indian tycoons that are seeking to potentially buy this franchise. But we still there are a few steps in this process. The franchise has received bids. Whether or not one of them gets to a point on signing a deal remains to be seen. We will proceed and will continue to follow the next steps on this one. But yeah, definitely the franchise has attracted interest from all the parties. So it remains a competitive contest as of now.
Yeah, well, the IPL, of course, has been enormously successful. Can you give us a sense of how big it's got, what's driving the interest, and if there are any other teams that are being targeted at the moment?
Yes, indeed. Other teams are being targeted or proactively shopped around. We've reported on the Rajasthan Royals, just to mention one. But I think cricket in general in India has attracted interest. And also for some of the owners of their franchises, go back to the challengers and the owner, Diageo, right? It's a bit of a non-core asset. So with this backdrop of interest from global investors to double down their bets on sports, cricket in particular, and then you've got some owners that may potentially see these assets as non-core to their portfolio. So it's a perfect combo for deals to happen. Definitely, cricket and sports in general has been attracting a lot of interest globally. India in particular has been a good ground for private equity deals. We've seen an increase in deal making in the last couple of years in the Asian country. But I think sports in general has become a very, very interesting, exciting industry for deal making. I think global investors see potential growth when it comes to media and also expanding these franchises internationally.
Yeah. All right. Bloomberg's Manuel Baigorri, who leads our Asia deals coverage there. We have plenty more ahead. We're going to be joined by Manulife's Mark Franklin. He's going to discuss his market outlook as geopolitical risk rises. Plus, AlphaGrep's Bhautik Ambani is going to tell us where he thinks traders should invest 1 million rupees. That's coming up on Insight. This is Bloomberg. Welcome back. You're watching Insight. Let's take a look at how markets are tracking this Friday in the Asia Pacific. We're seeing a lot of risk-off sentiment across the board. Nikkei off by 1.3% now. We got some pretty weak inflation numbers out of Japan a little bit earlier. The inflation gauge slowing to its weakest pace in 2 years now. Consumer prices, excluding fresh food, rising 2% from a year earlier in January. Most of the major markets are softer. We are seeing a bit of geopolitical risk at the moment as the U.S. assembles a considerable military force surrounding Iran. Brent crude prices up 71.89 per barrel. We're seeing a haven bid as well. Gold just below $5,000 an ounce. We've got the yield in Japan at 2.115. The outlier there, the Kospi, better again, 1.8%. What risk? We've got defense stocks rallying alongside AI names in South Korea. The Kospi now up about 36% this year. Well, the focus is on growing tensions in Iran as President Trump ramps up pressure for a nuclear deal. The U.S. military gathering forces in the Middle East, including 2 aircraft carrier groups, fighter jets and refueling tankers, as President Trump warns Tehran has just days now to work out an agreement. President Trump addressed the talks with Iran while he was speaking at the first gathering of his Board of Peace.
Iran is a hotspot right now. Good talks are being had. It's proven to be, over the years, not easy to make a meaningful deal with Iran. We have to make a meaningful deal. Otherwise, bad things happen. We do have some work to do with Iran. They can't have a nuclear weapon. It's very simple. You can't have peace in the Middle East if they have a nuclear weapon.
All right, for the latest, let's bring in Horizon's Middle East and Africa anchor, Joumanna Bercetche in Dubai. So, Joumanna, we heard the president there saying that he needs a meaningful deal or bad things will happen. What is meaningful and what is bad?
Well, that is exactly one of the quotes that he made later on in the day. And then also when pressed by reporters, he was asked over what timeline he was envisaging these negotiations could go on for. And he said maximum 10 to 15 days, which does insinuate that if there is no compromise reached between the two sides over the forthcoming negotiations, then we could indeed be going down the route of military action. And all of the evidence would suggest that that indeed is the path that the U.S. are looking to follow. There has been a huge buildup of military assets in the region over the last couple of days. Just to give you some context here, it massively dwarfs the buildup that we saw prior to Venezuela earlier this year, and is the largest buildup of assets in the region since the Iraq War in 2003, so even surpassing that of what we got in the U.S. Iran-Israel war last year, that 12-day war. In terms of what is being sent to the region, well, it's pretty formidable. We've got 2 aircraft carriers, missile destroyers, F-35 jets, helicopters. Tracking sites are also reporting that there's been a surge of flight activity by U.S. military transport, aerial tankers, and surveillance aircraft, all heading towards the region. Now, it was reported that on Wednesday, President Trump did sit down with Jared Kushner, his son-in-law, and Steve Witkoff to discuss how the negotiations in Geneva went. And while both sides said that there was some quote-unquote progress, still a lot of daylight between U.S. and Iran versus what the U.S. is asking for and what Iran are ready to deliver on. At the same time, according to a security official, the information that was handed to President Trump is that it would take another possibly until mid-March for all of the military assets to be deployed where they want them to be in the region. So at this point, there's been rampant speculation that if the U.S. do go down the military route, this would not just be for a limited strike or a 1 to 2 day thing. Given the amass of equipment in the region, it would probably suggest that they're looking for more sustained and prolonged military action. In return for that, Iran have also warning about possible retaliation on U.S. assets as well.
Well, let's talk about that possible retaliation. What do we know about how Iran is preparing for the worst-case scenario?
Well, interestingly enough, today we have a weekly documentary up on the terminal, which I suggest viewers go and see, about Iran's leadership and how they're at this extreme moment of weakness. And that has all happened or crescendoed over the past year since the 12-day war. The economic situation is dire. We had those demonstrations at the beginning of the year brutally suppressed the protesters. Remember, this was the origin of all of this. The U.S. president saying help is on the way vis-a-vis the protesters. And while the protests have died down, the focus from the Trump administration hasn't. So at this point, one of the big questions and overarching questions is, what is the U.S. trying to achieve here? Is it more military strikes on specific military assets, on their air defense system, on their nuclear facilities, or is the actual target going to be regime change? In which case, what we've seen is the Iranian side have been trying to reconstitute over the course of the past year. The satellite imagery suggests that they've been rebuilding up their ballistic missile launch pads. They have also been strengthening some of the governance by placing certain figures in the Supreme National Security Council. And I think from their perspective, they do have a plan B in place in case the U.S. go down the route of looking to forcefully remove or possibly even assassinate their supreme leader. And you will recall that last year, Paul, in the early days of Operation Midnight Hammer, the U.S. actually did succeed at taking out many key figures within the IRGC, but they were very quick to reconstitute. And I think this time around, they're probably thinking they need to have a plan B in place in case that actually does happen. So from a ballistic missiles perspective, from a governance perspective, and then also in terms of holding these military drills around the Strait of Hormuz, they themselves seem to be preparing as well for a possible strike from the U.S.
All right, Horizon's Middle East and Africa anchor Joumanna Bercetche there. Well, let's get some market insights now from Mark Franklin, Deputy Head of Asia Multi-Asset and Manulife Investment Management. Mark, thank you so much for joining us. And I want to start by asking you, how much of a war premium do you feel is priced into oil at the moment?
Good afternoon, Paul. The short answer to that is some, but not enough. if you look at the build-up of military assets, some indirect threats towards disrupting the Straits of Hormuz, it's quite conceivable that the geopolitical risk premium in crude oil could go meaningfully higher than where it is now. But let's take a step back from that. The fundamental supply-demand picture for crude is still pretty well balanced, quite muted in terms of the longer-term price outlook for oil. And then the second point to highlight as well is that longer-term oil price, if you look along the futures curve, are broadly unchanged and at a relatively muted level. So the initial response would be probably a spike in shorter-dated futures and spot prices, but unlikely to have meaningful implications for longer-term oil price assumptions.
So how high do you feel oil prices could move if we see a conflict break out? And to what degree could that be cushioned by a market that's still pretty much an oversupply?
Well, it all comes down to the extent to which oil throughput, seaborne oil throughput, gets disrupted through the Straits of Hormuz. It accounts for anywhere between 20 and 30% of global seaborne throughput. So anything that meaningfully disrupts that could inevitably drive a spike in shorter-term oil prices. In the absence of that, you're likely to see a more muted upside response because ultimately we need to make sure that seaborne supply-demand dynamics are largely unaffected. And then the other question as well is, the extent to which that is going to impact economic activity. That's really a question around the duration of any conflict or any conflagration that emerges. If it's a short, sharp interaction of a few days, it's unlikely to have a meaningful impact on economic data. But if it prolongs beyond a couple of weeks, then yes, it could impact global growth dynamics.
Well, amid all of this saber-rattling rhetoric, how are you positioning at the moment? And I'm thinking particularly the United States versus other markets.
Well, that's been more driven by a broadly risk-supportive global macro backdrop. You've got relatively easy financial conditions, fiscal policy pro-cyclical in most major regions around the world, most central banks in easing mode with the exception of the Bank of Japan, of course. And that kind of backdrop has definitely incentivized investors to look to diversify away from the US towards regions such as emerging markets, to some extent Japan and Europe as well. So in that broadly growth supportive and risk on backdrop, we've been looking to globally diversify our portfolios and skew more towards pro-cyclical exposures. And that's not out of a sense that there are major risk factors that are accruing with the US equity market, but just a recognition in terms of composition. You've got a large concentration towards the large cap growth names, whereas if you want more pro-cyclical exposure, other regions tend to have a more pronounced factor exposure in that direction.
In terms of sector-specific exposure, we saw some interesting moves in the past couple of weeks. AI first came for software stocks, then it came for real estate stocks. What's next? Do you feel that fear sentiment is coming for anything else?
Well, it's very interesting, isn't it? There's going to be some profound dislocations in the legacy economy as a result of AI, some good and some bad. On the bad side, those business models that are predicated on outsourcing relatively commoditized software development could be at risk because more corporates will self-fund their own AI initiatives to bring some of that activity back in-house. But on the flip side, there are some positive implications. If you're able to realize productivity gains, efficiency enhancements, by displacing relatively manual processes, by leveraging AI, that should be margin accretive for many, many businesses and many sectors. Think about financials as an example. Some businesses, whether it's banks or insurers, relatively labor-intensive manual processes, huge efficiency opportunities there as well. So it could actually be a margin enhancer on the flip side. So it's really about being selective and thinking through the first and second and third order derivative implications of what AI could mean for the traditional economy.
Yeah, and in terms of that sector-specific story, I mean, we've got an interesting case study in India, for example, where we've seen these big software names getting absolutely belted over the past couple of weeks. But then again, there's a couple of traditional stocks, like an old-school motorcycle manufacturer, a pharmaceutical company, they're performing very well, in fact, outperforming the index. So does that speak to a need to be very selective when you come to picking stocks?
Certainly from a sector and a corporate operating model perspective, the answer is yes. India's an interesting case study in points. There are these major global secular shifts at play here, and most markets will be touched by that. But then those markets that either have an equity market composition which is very well diversified, or in some cases where governments have the fiscal firepower to enact self-help policies, either to invest in new areas of growth or to cushion downside risks for the legacy economy, markets will be affected in different ways. India's a case in point. There's a large sector exposure towards software, outsourced software, as you rightly point out. But those more domestic-oriented growth sectors, because of the result of consumer penetration, they'll fare relatively well. And it's been a bit of a case where the baby's been taken out with the bathwater as a result of some of these secular shifts. So you're seeing pockets of value indeed open up through business models that are somewhat insulated from some of these secular shifts.
Mark, before we let you go, I'd like to get your views on China as well. Of course, mainland markets closed until next Tuesday for Lunar New Year, but we've got the Hang Seng back today, and it's losing a bit of ground. To what degree do you feel the action that we're seeing in H shares is going to be a sentiment gauge for Chinese equities when we get back next week?
Well, over the longer term, those markets are correlated undoubtedly, but what we've seen in the last few months is a real pickup in trade volumes in the onshore markets, which is symptomatic of retail investors starting to re-engage in mainland stock indices. So we actually think at the margin, mainland indices may well fare somewhat better than the offshore markets in Hong Kong, which are a bit more susceptible to institutional investor and asset allocation flows in and out of Hong Kong, which have been a bit sensitive to both interesting opportunities elsewhere in the region, but also question marks over the determination to inject policy stimulus in the China economy. But for the time being, we think that both markets are probably going to tread water until we get a bit more clarity around what the policy formation cycle will be, and we'll need to wait for a few weeks after the resumption of activities post the New Year holidays for that.
All right, Mark Franklin of Manulife Investment Management, thanks so much for your analysis today. Still to come, we've got more from the India AI Impact Summit as we speak exclusively with Zoom's Chief Operating Officer, Aparna Bawa. This is Bloomberg. OpenAI says it has visibility into its future chip needs, even as the industry faces a supply shortage. Chief Global Affairs Officer Chris Lehane also told us democratic nations need to develop shared safety standards for AI.
If democratic AI is going to prevail, or if the world's going to build out on democratic AI, I do think the world does need to work together collectively to make sure you're addressing and identifying the elements that are going to be needed. And look at, we are, and I know you guys talk about this and cover this, right, in a unique and perhaps challenging geopolitical moment where I actually have some optimism in terms of where the world's going, particularly democratic world, is that we all are going to have to work on this together. Democratic societies do need to start to develop shared safety standards on this technology. You're seeing emerging AI safety institutes, U.S., U.K., Japan. Australia has an early version. India's thinking about an early version. And he talked about, can we think about this as some type of analog to the IAEA, the International Atomic Energy entity. But I think those are the types of I think muscles that we're going to really need to develop to ensure that democratic AI does get built. But inclusive within all of that too is how do we all work together, particularly on the supply chain piece.
But as it stands now, do you see this chip shortage deepening further? And will that slow down the AI build out? From your perspective, how does it look?
From our perspective, I think, look, we feel confident that we have visibility onto what we are going to need. Now, we also make sure we sleep with one eye open, right? Because you want to continue the old line, trust but verify on all of this. We ourselves are, working with a variety of really strategic partners who are, really supportive of us in terms of access to chips. We ourselves think about how do we impart our knowledge on chip design.
That's OpenAI Chief Global Affairs Officer Chris Lehane speaking with Bloomberg's Haslinda Amin in New Delhi. Staying with tech, Indian IT firm Wipro says it welcomes the disruption caused by AI because it can bring fantastic opportunities. The company's global chief privacy and AI governance officer, Ivana Bartoletti, also told Bloomberg inclusion has been a key focus at India's AI summit.
Now with agentic AI taking the center stage this year, clearly that brings new complexities from a security and architectural, but also from an ethical standpoint. But the key words here have been really about inclusion. When I'm sitting at the moment, I can see just in front of me, I can see a poster which says, for India, artificial intelligence stands for inclusion for all. And that reminds me of, the key essence of the summit, which was also the key essence of Modi's speech yesterday, which positioned India as a country to do innovation with, because it combines the ability of scale up artificial intelligence and technology on a country on 1 billion people with an enormous appetite that people here in India have for innovation and transformation.
What is the capacity, though, of India really, do you think, to have a share or a say on the global stage? Because this has really looked so much like a two-horse race between the US and China when it comes to the entire AI stack.
We live in a world where large technology companies are in mainly two places in the world, the United States and China. What Modi said yesterday quite clearly was, we are open to innovation. We have the ability to scale up. We can't produce things and then bring it to the rest of the world. So the message was develop and solve here in India and then bring it around the world. It is clearly a different way of doing things. From a regulatory standpoint as well, it's really important to note that India is positioning itself as a safe partner to do innovation with. They have adopted a techno-legal approach, which is, for example, different from other approaches around the world, which is very much around full life accountability as of any AI system. There is one point that is also very much worth mentioning, which is, yes, this has been a summit about inclusion, about democratization, about impact on the world, on the economy, but it's also very much been a summit about infrastructure, because as was mentioned earlier, AI is not just about technology. AI needs land, AI needs earth, AI needs minerals. So the investments that we have seen are very, very crucial. So companies investing in data centers, and in a country like India, where the government announced a tax relief for company investing in data centers, as well as in sea cables, as the announcement coming from Google. So it's really important to understand that infrastructure plays a key part in all of this, and this is also where India is trying to really put themselves in the race.
Do you really get that sense that the governments have any sort of say in the way that this technology is being developed at scale?
When Prime Minister Modi says inclusion, what they mean is AI that works for India. And that means, for example, respecting the diversity of languages here. It means respecting the broad norms that are in India. So not just importing tools that come from other parts of the world, but also can be deployed and use cases that can really serve the Indian market. Now, in a country like India, talking inclusion is not just about the nice thing to do. Talking inclusion in India is also about economic growth and is about performance. So we have to take into consideration the peculiarity of India. I want to reiterate, talking inclusion in India is about talking performance, and this is very, very important. I think, yes, obviously this is a market which is dominated by large tech corporations. I think the United Nations General Secretary yesterday said it very, very clearly. And I think it's important, and this is also why many countries around the world are developing their own strategy for strategic sovereignty in particular areas where that is very much needed. I think also the investment and the Prime Minister Modi yesterday made on open source source is something that is very, very relevant. What he's basically said yesterday, we need open source. It has to be very, very important, an important part of our growth strategy. And I think this is, again, one point that goes in the direction on more sort of strategic sovereign and autonomy.
Invest. That's Wipro Global Chief Privacy and AI Governance Officer Ivana Bartoletti speaking to Bloomberg's David Ingles and Annabelle Drillers. Let's take a look at how Asia benchmarks are tracking at the moment. It is broadly a risk-off day across the region. We've got the MSCI Asia Pacific off by about 0.5%. Of course, the threat of war casting a shadow over markets as the US assembles a very large strike force around Iran. 2 carrier groups present now, and that is weighing on most indexes. The Nikkei weaker. We had a weak inflation print out of Japan earlier as well. The Kospi, though, just playing by its own rules there, better by almost 2% now. Tech stocks gaining again, joined by defence stocks also rallying hard in South Korea. Coming up, where should India's traders invest $1 million rupees? AlphaGrep CEO Bhautik Ambani is going to give us his view next and explain why he's staying cautious but isn't bearish. This is Bloomberg. Welcome back. You're watching Insight. Let's take a look at oil prices at the moment. Of course, against the backdrop of what's happening in the Middle East, 2 U.S. carrier groups now in position in the region around Iran. President Trump saying he's looking for a meaningful deal on Iran's nuclear program. Otherwise, I quote, bad things will happen. So we've got crude prices rising. Brent at the moment, $71.91. Oil companies also rising off the back of this tension as well. Well, Paraguay's President Santiago Peña says he applauds President Trump's decision to launch a military operation to capture Venezuela's Nicolas Maduro. Peña also told us Latin America could benefit from Trump's renewed focus on the region under his interpretation of the Monroe Doctrine.
I fully support. I think this is something that we have been aiming for a very long time. We had a long history of good relation with the U.S., regardless of who was the president or what party they were representing. But the reality is that always we have a closer relation with a Republican government rather than Democrats. So this time Trump came with a different approach, much faster on deciding on things and paying a lot of attention to the Western Hemisphere. So when the new national security strategy came out and they start talking about revitalizing the Monroe Doctrine, I think it's a good idea. I mean, it's not that we're going to be the same countries that we were 200 years ago. We are completely different, and the type of partnership that we have built is different now, is stronger, and we see each other as an ally. So it's not that the U.S. will colonize the countries in the Western Hemisphere. So I really appreciate that they're paying more attention. I think that there are so many things that we could do. And in the case of Paraguay, of course, we are the only country in South America that still have relation with Taiwan. Mm-hmm. So this is not a minor issue when they think about the influence of China in the Western Hemisphere.
I do want to ask you about Taiwan, but if we could stick with Venezuela for just a moment longer. Do you see Latin America as now being safer, more stable after the capture and arrest of Nicolas Maduro? And how do we guarantee that that is something that can last? Is Delcy Rodriguez the person who can complete that job?
We need to work around on this, and it's going to take time. And Paraguay knows very well. You know that Paraguay had the longest dictatorship in South America, 35 years of a military regime that ended in 1989. So the transition after the military regime, it took around 4 years. A transition government, a new constitution, and elections, and after 4 years we can resume on democratic terms. So this is not something that you're going to solve in 8 weeks, because it happened only 8 weeks since the removal of Nicolas Maduro. Of course, we don't like this as the first choice, but it's the second best. We push for democratic elections through the elections that happened in 2024. They did not respect the results, so there was no other option. So dictators, they don't go with pamphlets and manifestations on the street. They usually go with bullets.
Until there are democratic elections, are there opportunities for Paraguay and Venezuela in terms of your relationship and economic relationship in the interim, or do you need to wait to see that happen?
I think for us, it's not a matter of a lot of pressure. We don't have a lot of pressure. Paraguay is an economy that's growing. Is actually the fastest growing economy in South America for 3 years already. So we're doing really good. We are exporting and doing trade with many countries. We have a lot to offer. But we don't depend on accessing the Venezuelan market. I think that now the challenge is how to stabilize on the ground, particularly freeing all the political people that is imprisoned, allowing Venezuelans to return to Venezuela. And with the situation more stable, I think the most important thing is letting the people of Venezuela to choose who's going to be the president. And it's going to take some time.
Do you have an idea of how long?
If I give you my own experience in Paraguay, it took around 3 to 4 years. So I hope that it could be sooner, but it's going to be around that time.
It's Paraguay's President Santiago Peña speaking exclusively with us in Washington. Let's take a look at how Indian IT stocks are performing this Friday. We do see ongoing weakness there, although a lot of the selling does appear to have abated compared to what we've seen recently. Infosys, the worst performer there, off 1.3%. And we've seen heavy foreign outflows in this sector. Foreign investors at the end of 2024 owned more than $85 billion worth of these companies. By the middle of February, that had slumped to $49.5 billion. Well, while the impact of Anthropic's new tools have sent shockwaves across markets, it's been a challenge for equity investors to find indirect exposure to the closely held startup. Unlike other AI major players, there's no clear way to bet on Anthropic's success. So instead, investors are looking for more tangential connections, such as Cloudflare, which soared in late January on reports of rising adoption of an AI assistant that works with Claude. Or Zoom, which invested $51 million in Anthropic in 2023, and that's a stake that could now be worth billions. With us now is Aparna Bawa, COO at Zoom, and she joins us from the sidelines of the India AI Impact Summit in New Delhi. Aparna, thanks so much for joining us. I mean, you heard me mention their Zoom stake in Anthropic. I'm just wondering if you can update us on the current value of that, and do you have any kind of contracts or partnerships in place at the moment?
I think you will have to look at our public filings for that, and when we publish earnings and also file our 10K, or 10Q, you'll have to look at our public documents for that commentary. I will say it is wonderful to be here at the AI Summit in India. The Indian government has laid out a plan that is focused on inclusivity and economic progress, and Zoom is very well aligned. If you look at when we were founded and what our mission was when we were founded, we are all about inclusive and progressive participation from entire broad swaths of the economy, and we look forward to continuing in that sort of AI-powered collaboration.
In terms of that Anthropic stake, though, I mean, it has generated a lot of interest in Zoom. Do you find that you have investors talking to you, analysts talking to you about that? Is it helping build interest in your company?
You know what? We are focused on establishing ourselves as a platform that drives AI-powered human connection. We definitely look, at the broader industry. We are more focused on sort of driving productivity gains amongst our enterprise customers and amongst our small and medium-sized business customers. And to that end, we're a platform that is used across the board by multiple parts of the economy, and that is what we're focused on.
In terms of other things that you're focused on, we've heard the Zoom CFO, Michelle Chang, talking about a brand refresh, which is coming soon. I'm wondering if you can tell us a little bit more about what that might entail.
Absolutely. So, we are definitely focused on our AI-powered collaboration, and that includes looking at different ways in which we power enterprises. And it's all going to be about inclusion, reaching different parts of the economy, different parts of society, and establishing lots of forward momentum.
So There's a bit of growing concern at the moment. This is a theme we've talked about a lot, that AI is going to replace a lot of software as a service applications, particularly when it comes to customer engagement. Do you feel Zoom's vulnerable to this trend? Is it something you think about? Is it something you plan for?
Look, we are the closest possible source of, our customers and engaging with our customers in terms of generating their conversations. And I will say we are the best positioned to enable that conversation to task completion, so workflow completion. While we know what this has been a topic of conversation, we're very confident that we can provide value to our enterprise customers. Of course, we have made a very strong statement that we don't use our customer content to train our own models. But we are optimally positioned to drive that conversation to completion workflow and enable significant value for our customers.
Are you able to quantify the recent success that Zoom has had in cross-selling the Zoom phone and the contact center?
Yeah, absolutely. Phone and contact center are incredibly important for us. So far, we've had over 10 million seats globally. We continue to expand across the globe, including India, where we've had significant progress establishing ourselves as a key player. And contact center is so important. For example, contact center couples very well with our virtual agent and our AI-based platform to drive significant gains for our enterprise customers. We're seeing tremendous growth from this product, and we continue to see this as one of the premier drivers for growth for us.
Yeah, it's a crowded and competitive market, though. How do you stand out, and what's sales growth looking like there?
Well, you know what? It's all about how we power AI for our customers. And if you think about it, we've been in this space for a very long time. Customers trust us with their most sensitive communications, and this is something that when it's native AI-based, native solution, we can really compete, and it is one of our top sources of growth for our business.
Overall, can you give us a sense of what percentage of your sales are coming from some of these new products, and how fast is the category growing?
The category's growth is tremendous. We are seeing contact center, virtual agent, et cetera, be part of the drivers of growth for our business. I will say that, while we don't quantify the specific growth from each product, this is where the growth is going to come from. Zoom Phone coupled with contact center, virtual agent, and sort of the AI-based solutions for this sector.
Yeah, and you made the AI Companion 3.0 commercially available recently. Can you give us a sense of the sell-through for the paid version of that?
Our AI Companion is doing quite well. We are growing. I think it grew more than 4 times from initial launch last year. And I'm going to tell you that this is going to be one of the premier drivers of growth across our suite. So it's embedded into our complete suite of products, including, most people know us for our meetings, but including our team chat, our phone, our contact center. It's the same AI Companion that drives significant value for customers because it does enable them to finish to complete their conversations and take it into agentic workflows and get things done in a very productive way.
Well, you're joining us from the AI Summit there in India, and you've previously described India as a great jumping-off point for tech in Asia. Can you talk to us a little bit about what's coming out of your R&D centers in Bengaluru and Chennai?
So we have R&D all over the world, including in Bangalore and Chennai. It's super important for us. And in fact, we develop we've got our DevOps center here, as well as we develop products like contact center here. India is such an important market for us. It is not only a regional base, but it is also a place where every multinational does business, and you have to have a connection point for every single corporate business out there. The other thing is India is a huge, huge talent pool and a market for, with folks who are eager to adopt technology. Here in the AI Summit, what's been really, really incredible is to see the startup ecosystem and all the entrepreneurs that are, trying to establish themselves as relevant players in the app ecosystem, the application ecosystem. I think India is going to do tremendous things. The focus on upskilling, including broad swaths of the economy is bound to just drive progress. And this is something that where Zoom leverages really well. Our product is incredibly easy to use. Over time, we see even the AI usage to become something that, even farmers can use it, people in the field can use it, people in various industries. You don't really need you don't need to understand how to code. It will be over time just through voice and chat, and you'll be able to drive, maybe even develop your own code, develop your own models. So we do see that India is a tremendous jumping off point for this.
All right, Aparna Bawa, COO at Zoom, thanks so much for joining us today. And we have plenty more ahead. This is Bloomberg. Welcome back. You're watching Insight. Let's take a look at how Indian markets are tracking. It's a pretty quiet day, to be honest, although the losses we're seeing, we've turned to gains now. We were in negative territory for a while there. The Sensex now higher by 1/5%. Some of that may be due to the performance of India's oil companies because, of course, oil catching a bid on the back of tension in the Middle East. However, some of those tech names are still selling off today, although not quite as at the aggressive pace that we saw over the past couple of weeks. For more on the outlook for Indian equities, let's get to our Bloomberg India equities reporter, Alex Gabriel-Simon. So, Alex, some are seeing hope now on the horizon for Indian stocks due to a revival in earnings. What are we seeing?
That's right, Paul. To put it very simply, the earnings was somewhat better than expected. We calculated the proportion of companies that actually beat their expectations for earnings, and that proportion was actually the biggest we've seen in about five quarters. And more importantly, it provides a very important lifeline for the market that has otherwise been struggling with geopolitical headwinds, as well as headwinds on the artificial intelligence side. The profits for Nifty 50 companies were up about 10% year on year, but more importantly, analysts are estimating about 16% an acceleration in the next financial year.
So what changed the outlook on Indian earnings? Because it was only a couple of weeks ago that investors were worried about earnings growth, that had been lagging for months. So how did things switch around so quickly?
It's been an issue for a while, Paul, and that's been something investors have been talking about after each quarter. And this is the first time there seems to be some optimism now coming up. Kotak's analyst Sanjeev Prasad put it very simply that the accelerator and the brake for the market is on at the same time. We are seeing high-frequency indicators sort of showing an uptick, but at the same time, valuations are always pulling the market down, and that has been a concern that is still lingering around.
All right, Bloomberg India equities reporter Alex Gabriel-Simon there. Well, the latest installment of Bloomberg's Where to Invest series tells us how financial experts would spend $1 million rupees. That's about $11,000 at this time. Menika Doshi joins us now with all the details. So, Menika, what's the latest?
Hi, Paul. We've got a bunch of recommendations that range from mid-cap stocks to rare earths to gold, of course, high-grade corporate bonds. And, in our how do I put it, out-of-the-box recommendation is a proposal to invest in a music library. Now, like I said, gold is pretty much on everyone's recommendation list, even now when we have 4 experts in that piece, which is a very popular read here in India. But otherwise, the strategies seem to range from, let's be cautious, there are challenges yet, and the other side is the worst is behind us. I have someone from the former camp, Bhautik Ambani. He's the CEO of AlphaGrep Investment Management, and I think he is advocating a significantly cautious stance. Why is that, Bhautik? Your portfolio strategy, as quoted in the piece, is not exciting, not flashy, but sensible.
Thanks, Menika, for having us here. To be honest, what we are seeing today is what is being told to us by our data. We're a quant-focused house, so data speaks a lot more to us, and we just follow what the data tells us. To a certain extent, what we can make out of this data is, at this point in time, we've had a phenomenal run over the last few years in the Indian markets. And to a certain extent, we believe that the valuations have kind of run ahead of its time.
Even now?
even at this point of time, like we just heard Alex.
We've seen a significant time correction.
We
right?
have. Having said that, we just heard Alex, right, saying that we've seen Nifty 50 earnings growth go up by around 10%, but we're still paying more than 20 times for that, right? The other anecdotal data is, if you think about it, you're still having foreign investors either not putting in money in Indian markets or they're still continuing to pull out, right? So in some sense, you're seeing professional investors not look at Indian markets yet, right? Bulk of the emerging markets have continued to do well. Despite that, India has been lagging entire 2025. And I personally believe, or at least our data tells us, that we're going through some kind of a regime change, a structural regime change in the markets. And that's thanks to what we're seeing globally.
What does that mean, a structural regime change?
Structural regime change is, when you are seeing fundamental changes in the market, which can be thanks to, let's say, policy changes globally. We are seeing divergence around that. We are seeing divergence around what we're seeing with metal prices, right? We had seen like a phenomenal like we had seen a long period where metals didn't do well in India, or even global markets for that matter. In the last couple of years, we've seen them do well, including coal, silver, and a lot of other non-precious metals as well. We're potentially going into a phase where we might see a structural bull run in the metal space as well. So if that's, and geopolitics, right? Like we're in the midst of it right now.
Yes,
and
we woke up to the Iran headline this morning and oil price is much higher.
So there are multiple things which are happening out here which can potentially lead to some kind of a regime change in the markets, right? Now, when something like that happens, what one tells you is that whatever's kind of working in the last few years may not be the same, which will kind of continue to do well going forward.
Let me get a little bit more specific. You mentioned two things, valuations and the return of foreign investors, which is yet to happen, only happening on the margin. But they are, in some sense, sort of contrary to each other, right? Because if foreign investors do come back, in fact, prices will only just go up. And so your valuation argument then gets defeated. So what would you prefer, or what would you like to see change for your position to become more aggressive? Let's say on equities, which right now you're recommending should be just 20% of the portfolio.
Yeah. So I think, from our perspective, we can change some of these stances very quickly. Right, so it's not that we're only looking at fundamentals. Right. So the way our model works.
What needs to happen in the market to change for your stance to change?
Sure. So again, like I'm saying, that from a market perspective, what we would like to see is, some kind of convergence between where valuations are today, right, and with where the prices are, right? So if that converges to a certain extent, then that will probably make us change our valuation or change our stance in terms of taking a higher allocation to equities. Because at least our model tells us today, from a risk parity perspective, fixed income is making more sense compared to equities, as per our model. And that's the reason we are more tilted towards fixed income compared to equities as per our model. Right?
In equities, you've recommended relatively safe plays, large cap stocks, and safe mid cap.
Right.
Some of the other conversation in that story seems to suggest that consumption might be a good place to be in. Is that something that you see reviving significantly?
So consumption, to be honest, hasn't done that well in terms of price move. We've seen a lot of other sectors which have done well in the last few years. So that is something which is a safer bet to take at this point in time and may kind of do well going forward. And one of the triggers for that is obviously the GST cuts that we've seen a few months back. Right? So that can lead to that.
So what do you like in equity? Very quickly, because I want to ask you a quick last question on that.
Sure. So from an equity market perspective, today we would just stick around. I'm not taking a sector bet here right now. I would just stick around with more large cap names or safer bets at this point of time in the equities.
All right, a quick final question on debt. 60% allocation is what you've recommended. Again, another recommendation seems to suggest 1 to 5 year high grade corporate bonds is where your money should be. Is that how you're viewing it?
Very similar. I would stick around with AAA names, safer bets at this point of time. Like I said, overall view is cautious. I think it's not stemming from what's happening in India, but I think it's what we're seeing globally as well.
All right, Bhautik. Safe. Paul, there you've got it. The Indian market burnt its fingers last year and is still going to take some time to recover and rediscover its risk appetite.
All right, Menika, thanks so much. That's Bloomberg's Menika Doshi with Bhautik Ambani, CEO of AlphaGrep Investment Management. Before we leave you, let's take a look at how we're tracking in Asia at the moment. Mostly a risk-off day, although only modestly so. The MSCI Asia Pacific off by about 1/3 of 1% now, and we're seeing some modest gains in India. Losing a bit of ground in Japan. We did get a soft inflation print out of Japan a little bit earlier on, but the Kospi just keeps on powering ahead, better now by 2.1%. 1%. Tech and defense stocks catching a bid there. Before we go, here's a look at some of our guests for next week. We're going to talk to HSBC CEO Georges Elredi about the bank's earnings. Also, Oliver Wyman, Group President, and CEO Nick Studer going to give us his AI outlook. But that is it for Insight. Horizons Middle East and Africa are up next. This is Bloomberg.